Hey everyone, I'd like to share more information about our monthly and quarterly investor reporting. So, without further ado, I'll share the monthly email that we send out for all of our projects. And so it looks something like this. And the most important feature of the email is this monthly collections and occupancy chart. The reason why we think this is the most important piece is it tells a very good story, and a picture is worth a thousand words. So with this collections chart, I focus personally on collections because occupancy is a bit of a vanity metric. You can have high occupancy, but it could be to the detriment of rents, it could be to the detriment of collections. And at the end of the day, occupancy doesn't pay the bills, it's money in the bank. And so our team, we are hyper focused on money in the bank, monthly collections, and that's what you see as the bars on this chart. The lines are occupancy. So you can see, just for reference here on this chart in particular, we have 95% occupancy as the underwritten projection for occupancy for this deal. And that's the gray line that is going across towards the top. And that's at 95% as the projection. And then the blue line is actual occupancy month over month over month since we acquired the property. And so you can see in September, we saw a dip to a bottom in the low 90, in the like around 92% occupancy. And then now you can see as of the February line, the occupancy is now well above 95% into the high 90s. So there's the variation there. And of course, like we said, it's all about money in the bank. So if you track the collections on a monthly basis, this is where we think there's the most value because this is where really the rubber meets the road. And in our underwriting projections that we use to build our return projections for investors, we of course have revenue projections, and those are very important because revenue obviously is a major driver to your overall P&L and overall cash on cash returns and value of the property for investors. And so here you can see we took over the property and collections were slightly above and right in line with underwritten expectations, the gray bars being expectations or projection, and then the navy bars being actual collections month per month. And so there's natural variation with monthly collections. There's noise in the data. It could depend on the day of the week that the month closed on. If the last day of the month is a Saturday, and so, you can't get all your checks deposited and things like that. And then there's other features. It could be a shorter month, a longer month. It could be a winter month. It could be a summer month. So there's a lot of seasonality and noise, if you will, month over month. Nevertheless, we still track this statistic month over month and are hyper focused on it, as mentioned. And what we love about these charts is here we only have, it looks like around 7, 8 months of data, or I guess 2, 4, 6, 8, 10. So we're approaching a year of ownership here. But normally we would show a trailing 12-month chart for occupancy and collections. And this gives a good picture not only for current performance, but also for trend. Trend is super important because we want to see, obviously, not just where we are, but where we've come from. And hopefully that's an indication of where we're going. And so, for example, the first few months of collections were around 390-ish thousand. Then they dipped a bit, and we're at now we're right around at 390 again. So the collections are about uh, stable, around even, and beating projections. And this chart is actually very unique and has a unique feature because if you notice, the January and February bars for expectations dropped. And that doesn't mean we've actually projected a drop in revenue. It actually means that we were able to secure a property tax exemption for this deal, and therefore we offset the abated taxes against our projected revenue because we're going to have to lower rents in order to satisfy the requirements of the affordable housing project in exchange for the tax abatement. And so that's why we offset the projection by the abated tax to kind of compare apples to apples. So you can see that by virtue of the tax exemption, as it stands currently, we'll have to lower rents a little bit, but we're now beating overall revenue projections, taking into account the tax exemption in this case, which is obviously a big net benefit for investors. And that's actually how we're currently distributing 8% cash on cash to investors, whereas we only projected 5.3% because in this case, we were conservative from the outset and we didn't project achieving a property tax exemption on this deal. We projected paying regular taxes for this deal. But that's a unique circumstance. I really just want to focus on explaining this particular chart because I think this chart tells a lot of information, but without fully understanding it, maybe it doesn't have as much meaning. Also, another question, a question that was recently asked by one of our investors about this particular chart is why don't you report on NOI instead of revenue? Because these monthly collection bars is basically just revenue, but obviously the whole other side of the P&L are expenses. And NOI would tell you a more full picture about the performance of the property because it would take into account expenses. And while this is absolutely true, it is perhaps not as helpful on a monthly basis. And again, this is the report that we send out or the email that we send out every single month. And so when you talk about noise, revenue is already noisy because of seasonality, because of certain months having more days, less days, and things can change. But when you factor in operating expenses, the noise on a monthly basis goes up dramatically because expenses are a lot more noisy. There's manipulation between expenses that are deemed operational and put above the line or factored into NOI. Then there's also, at your discretion, you can put expenses below the line or capitalize them, and then they don't show up in the NOI calculation, which could be valid or it could be misleading. There's also, you can have a month which has an extra week. So you have a 3 payroll month versus a 2 payroll month, and that can show higher expenses versus lower expenses. So there's just a lot more variation monthly in expenses, which would really show up a lot more noise in monthly reporting. And this is why I think when it comes to financials like this, it's really helpful to take a long-term view and look at 12-month periods. Even looking at quarterly periods is rather tight, and I prefer to look at the trends on a 12-month rolling basis, for example. And that's what we actually do on our quarterly reports. So if I go over to our quarterly reports, so for this same project, this is from the Q4 2024 report, so end of year, and we had owned the property for around 7 months. So this is actually not a full 12 months of data, but this is how the 12-month data shows up in our quarterly reporting. What we do is we actually show the underwritten projections for each line item or for each category in our underwriting for the 12-month period that is trailing the reporting period. So this report is for the end of 2024, essentially. So if we had owned the project for the full year of 2024, this would effectively be a full 2024 year review versus the actual results associated with that same time period. So we can compare projections versus actuals and in real true apples to apples comparison. And so you can see while there was variability, noise, and occupancy going up and down and collections going up and down, you can see that in some, we're effectively right in line with projections, exceeding the revenue projection by 3%. And then on the expense side, now with 7 months of data, it's a bit more accurate and it's actually more worthwhile to analyze this data. I mean, even still, this is only 7 months, which I would much prefer to look at a 12-month period and really look at things and get in granular and understand what are our expenses for a 12-month period on a per unit basis, of course, versus our budget, and to really drill down and see how we can try to continue to increase the value of the property for investors and enhance cash flow. But here you can see we're roughly in line on expenses. We're actually 2.4% above budget on expenses, so that's obviously not good. It is good to be 3.1% above underwriting on revenue, and which net results in a 3.8% actual result versus underwritten NOI. So hopefully that's helpful. Just wanted to explain kind of the dynamics between our monthly updates as really just something to stay in front of investors, provide relevant updates to the property, something quick to glance at. Of course, there's a link to the full investor Dropbox where there's all the financials from the profit and loss, the balance sheet, general ledger, and so on. But really, most investors just want to kind of scan the email. They want to read what any pertinent updates there may be. Of course, information about distributions, and then access to further documents. And then, of course, the chart that we mentioned. And then on a quarterly basis, we provide this full report, which has some narrative, has some pictures, and of course, the most important thing, in my opinion, has the variance report, which is really kind of brass tacks looking directly at, okay, what did we project versus what are the actuals? And then in this case, funny enough, there weren't any substantial variances to comment on, but oftentimes our asset managers will write in comments and we'll include comments in these reports to speak to substantial variances that there may be to kind of explain more as to what's going on at the property.